My name is Jake, welcome to the channel. In today's video, I want to talk about investing with M1 Finance. Now this video is not sponsored by M1, there's no sponsor on the video. So for those of you that follow the channel, you know that I've transferred my brokerages over to M1. I've actually done that twice. In September of 2021, I transferred my Vanguard account into M1 Finance, but even back in 2019, I transferred my brokerage from Robinhood into M1. And then here this last, September, it reset the performance or the history. But I have a few other accounts here. I have my real estate portfolio as well, where I hold my REITs. And I have a little account here for our baby boy, Lucas, where I transfer $25 every single week. But if I go into my real estate portfolio here, you can see that the portfolio has kind of just been, for the most part, on autopilot since the summer of 2019. I've just kind of, slowly dollar cost averaged into the portfolio. We sold a rental property and then I put in a little bit more money into the portfolio as well. But for the most part, it's just been on autopilot. But yeah, so these are the three accounts that I have with M1. So the focus of the video today, I want to focus on four topics. The first one, I want to breeze through and briefly talk about who should not invest with M1. Then second, I want to talk about, is my money safe with M1? With the whole FTX fiasco and all that good stuff, I want to talk about, is your money actually safe with a brokerage like M1? And then the third, I want to talk about the high yield savings account that's coming here in 2023. Not a lot of people know about this, but M1 kind of in the background have been putting this together, and spoiler, it is FDIC insured. So really, really excited about that. And then the last part of the video, I want to talk about portfolio modeling. So the majority of you are probably not going to understand or kind of have an idea of what I mean by portfolio modeling. But this is where I want to spend the majority of the video. So whether you use M1 or not, you'll get value most particularly from this part of the video, but even more so if you have M1, because I'm going to show you very simply how I do it and how you can do it as well to project how much money you'll have invested into each individual company if you have multiple slices. And I want you to kind of think about things in a different light. So really my goal here for this part of the video is that you kind of realize what it means to invest into a handful of different pies and what that could potentially look like in the future. And my goal is that you have that aha moment or that light bulb effect, from watching this part of the video. Because let's be honest, like a lot of stuff that we talk about here, it's, you didn't learn about this in school. You didn't learn about this in college. Most of the stuff here is all self-taught, learning by doing, watching YouTube videos, because investing, whether you've been investing for a couple of years or for decades, the market can be very humbling. I think back on my own experience when I first started investing, it was very challenging, very overwhelming in the beginning. And, it kind of looked a little like this.
I can't swim.
You can't what?
I can't swim.
How old are you?
6. Help him! He can't swim!
Time he learned. Everybody should swim.
I did it, Emerado! I did it!
Good.
Well, how will he get back?
Swim.
Well, he might drown.
Well, then you go get him.
Well, I can't swim either.
Oh my gosh. You know what? I look forward to making these funny clips. Like that is the highlight of my week. Like when I finalize the little tweaks and like that is my favorite part about making YouTube videos is I laugh and smile so hard while I'm making these. And I always bring my wife over to kind of take a look at it as like, hey, am I just weird or is this actually funny? Half the time I'm just weird and awkward and not funny. I have a weird sense of humor. But when I show it to my wife and she smiles and laughs, I know I'm onto something. And the buy my course, I can't take credit for that. That was actually her idea. She's like, have the lady run in and say, buy my course, buy Oh my gosh. Oh man. Okay. Anyways, where was I? I should seriously, like, I wish I could just talk about memes all day, but I don't think a lot of people like talking about memes all day. I do talk about memes on my Instagram. So if you like memes, you can check out my Instagram in the pinned comment. All right, anyway, so first topic, really quick, who should not consider investing with M1? M1 is really tailored for long-term investors who want to automate your investing. So if you're looking to day trade, buy in and out of stocks, set limits, all of those things, you do not want to invest with M1. When I first transferred over to M1, I was like, how do I submit an order? Why can't I sell? I was like, oh, this is very, very different. So M1 is really all about, long-term investing and not actively trading. If you go onto their homepage, you can see the words long-term a handful of times. So really in a nutshell, if you're looking to day trade, M1 Finance is not for you. Now, the next thing here, is my money safe with M1? Now, I want to be very clear that this impacts me as well, right? When I look at my portfolio balance, I'm just like, what if something were to happen? What would happen to my money? Especially when it's front and center with FTX. And is my money safe with M1? If you go onto their homepage and you scroll down a little bit, you can see, how M1 protects your account. So first off, they are a registered broker dealer. Like they are registered. So there is regulation in place with what M1 can and cannot do with your money and how they operate, right? So they are a member of SIPC. Your securities in your account are protected up to $500,000. They are FDIC insured with your M1 spend account. So this is what really caught my eye is it says your account is protected up to $500,000. I was like, wait a second. And so I was thinking, well, what happens to everything over $500,000? Now, obviously you're going to want to do your own due diligence, but I wanted to share with you something that some information that I got from reaching out to M1 directly. Now, once again, I'm not a spokesman for M1. This could be completely inaccurate. I don't know. So I can't really speak to the validity. All I can say is this is the response that I got from M1. I emailed them back in November and they said, hey, because I was reaching out regarding the insurance, right? Well, what happens to everything over the 500,000? All of your holdings at M1 are held in custody at Apex Clearing. Apex Clearing has been a FINRA and SEC regulated firm for more than a decade. All of your holdings are fully SIPC insured, and you, as the account owner, fully own your security. So I own them regardless of what brokerage they're in. The shares are mine. In addition, Apex Clearing has additional insurance beyond SIPC for $900,000 in cash and $37.5 million in securities per user. Apex Clearing has additional insurance, right? So they have it on top of it. So in my opinion, after reading this response, it really did give me a lot more peace of mind knowing that my money was secure here in M1 Finance. So now I want to talk about the high yield savings account that M1 has been working on in the background. Now, this is not, you can't put your money into this today. They're going to be rolling it out here in 2023, but they're coming out with a 4.5% high yield savings account. This is really, really cool. Not a lot of brokerages or banks are offering a high yield savings account at 4.5%. Okay, so I thought that this was really cool. One caveat to this though, this is a M1 Plus benefit that you get with being an M1 Plus member. With M1 Plus, I think it's like $125 a year. If I'm not mistaken, the first year is free, and then after that, you have to pay the $125. But you get other benefits with M1 Plus. I'm not going to go. I guess I can go in here really quick. So I haven't looked at this. What do they have in here? You get all of these benefits with M1 Plus. I'm not here to say either way if that's something that's right for you. I have it. I like it. I personally get value out of it. With M1 Borrow, you get better rates there. So you really have to assess if it's right for you. But I think it is pretty cool that they are coming out with a high yield savings account like this. It's what I think about it here is, it's like Amazon Prime. I don't use all of the features of Amazon Prime, but I pay for it yearly. And some of the features I get benefit from, But like, for example, Amazon Music or whatever, I don't use that. I use Spotify, right? Like, you have to kind of pick and choose if it's worth it for you. But for me personally, I'm pretty excited about this. This is definitely something that, where I would look to hold maybe an emergency fund. So yeah, maybe it's something to consider. Okay, for the remainder of the video, I want to talk about portfolio modeling. So what you're seeing here on your screen is my Excel sheet here from the Dividend Reinvestment Calculator. I have a tab in here called portfolio modeling. So if you want access to this document, this Excel, you can download it in the pinned comment in the description below. It's entirely free. You can download it. What you'll have to do is you'll have to go in and make a copy in order to edit it. Okay, but what you're looking at here, this is my portfolio. This is my portfolio in M1 Finance. I have my cash flow portfolio and I have my real estate portfolio. I made this spreadsheet here so that you can copy and paste and use this yourself and that you can update it for you. So over here, you see this updated field. So everything in this orangey color, is that orange? I guess that's orange. Everything in orange, you will want to update yourself. Okay, everything else, all the formulas will work. All of the formulas will work. All you'll have to do is update what is in orange. So I'm going to go from left to right and I'm going to explain everything. And then what I'm going to do is I'm going to show you a few examples of the portfolio of the subscriber that I spoke with and show you how you can do this yourself. Okay, you follow me? Good. All right, so here on the left, this is the monthly income that you're projecting once you reach your destination. So in January, this is the amount of income that I'm going to be generating with the following assumptions that we'll get to in a second. Okay, so in January, this would be my monthly cash flow from my dividend portfolios, and then in February, this is the cash flows that would be projected. And then in March, you can see the cash flows that would be projected, assuming that I am dollar cost averaging into my portfolio. And this is the portfolio allocation that I have set up. Okay. Now down here on the bottom left, you can see that on a quarterly basis, I'd be getting just under 19,000. And he times this 19,000 by 4, and this is how you get this number. Okay, so that's the left part. All right, now let's take a look at column J here. This is the projected quarterly income that I'm going to be getting from SEHD. So it's 2,635. Well, how did I get that number? So that number here is you take the amount that I have projected to be invested, the 340,000, and I'm timesing it by the 4-year average yield. And I'll show you how I got that in a second. Okay, so what I do is I take the formula there and then I divide it by 4 because it's paid quarterly. That's how I get this 2,635. So everything that is paid quarterly, it will follow the same process, right? And then you divide it by 4. If it's a monthly dividend stock or ETF, you will then divide it by 12 because you're getting it paid every single month. That's why this number is lower because it's divided by 12. And then you can see that this number right here is reflected here. And so when you're filling this out for yourself, for your own portfolio, if you want to do that, you'll have to update this depending on if it's monthly or quarterly. And then this, you'll need to fill out if it pays on a March, January, February schedule, right? Or if it pays every single month. Okay, the total amounts, you won't need to fill out the total amounts because the formula is already set for you, right? So I have the formula here. It's based off of the percentages here and the dollar amount that you have over here in this field. So this field will automatically update depending on the other fields that you have updated. Okay, so and this column right here, obviously you're going to need to update for you, for your specific holdings. For me, this is how I have it set up for my portfolio, and I can see if I were to dollar cost average into my portfolio, these are the holdings that I have. Okay, and right here, I have the weighting that I have in each individual company, and ETF. So 20% into SEHD, 20 in VYM, 10 in DGRO, and it goes on and on and on. That is for my cash flow portfolio. For my real estate portfolio, I have it down here, and I have it listed at 10% equally for the 10 REITs and REIT ETF that I have in my real estate portfolio. And what you'll notice is over here, and then going on to the all portfolio, so with everything combined, the combined percentage is 17% of my overall portfolio. And then as you go down here, you can see my individual companies that they represent 1.7% for my overall portfolio based off of my target, right? This is a target. This does not represent what is accurate today. This is a target assuming that I'm dollar cost averaging into my portfolio over time. So that's very, very important to remember. And then with my real estate portfolio is targeted at 1.5%. So that's what I'm talking about. If I'm saying, hey, don't have more than 5% in an individual stock, this is what I'm referring to when it comes to your overall portfolio. All right, the next part here is I use the 4-year average yield. So what I don't like to do is I don't like taking a look at what the current yield is today. I like taking the 4-year average. The reason why is I dollar cost average into my portfolio. I want to just use the best estimate that I possibly can, and that's why I use the 4-year average instead of the current yield. Okay, and as well as the dividend CAGR, I like using the 5 or the 5 or the 10 year. I'm a little bit indifferent whether you use 5 or 10. It's not as important in my opinion. You'll see both here on YouTube and floating around. So use whatever you prefer, either the 5 or the 10 year. And but this right here, I am a little bit more particular. I do like using the 4-year average dividend yield. And how you can get that is go over to Seeking Alpha. And for example, if you type in a company like, type in your ticker here, the company, go into the dividends tab, and then where you'll find that 4-year average is going under the yield section right here, and you'll see it right here. The 4-year average dividend yield. For Pepsi, it's 2.76. So for example, if I'm dollar cost averaging into Pepsi, I could reasonably assume when I'm projecting future returns, I could reasonably assume around a 2.76% dividend yield, starting dividend yield. Okay, so that's the key thing. Now, when it comes to ETFs, if you go in here and you try to do the same thing for an ETF, in Seeking Alpha, for whatever reason, in this view, it does not work for ETFs. Now, the way that I get this for ETFs is I go into the portfolio view. You can upload your portfolio into Seeking Alpha. I think you can do a few of them for free. You will need the premium version to upload more than I think 1 or 2 or 3, something like that. I can't remember. But if you want to get the 4-year average dividend yield for an ETF in Seeking Alpha, go onto, upload your portfolio or create a portfolio with ETFs, go into the dividends tab, and then here you have the 4-year average yield. And so what you can do is you can go under the ETF, find the ETF, and you can see the 4-year average yield for SEHD is 3.1. And if you want it for VYM, for example, it's 3.11. So that's how I'm getting the numbers for what I'm showing right here is that. Okay, pretty simple, pretty straightforward. And the 5-year CAGR, it's the exact same thing. You go under the dividend section and the dividend growth, and then you'll find the 5 or the 10-year CAGR, whichever one you want to use. Okay, now the last thing here really quick is if you have M1 Finance and you have different slices and you want to find the average, the weighted average dividend yield and the dividend CAGR, you're going to need to use a formula so that you can find that. And I already have it in here for you. You don't have to do this. This is my gift to you. It took me forever to figure this out when I first was looking for it. But this right here is the weighted average dividend yield of this portfolio, the weighted average. And the weighted dividend compounded annual growth rate is just under 9%. It's also right here. So I already have these formulas for you. You don't have to Google it and watch YouTube videos to figure out how to do that yourself. I have it here for you. Okay, so now I know that this was a lot of information. If you really want, if you missed a part or you kind of were unsure about a different area of what I just explained, maybe you can go back and you kind of rewatch what I was just saying. But in a nutshell, this is my entire portfolio. This is how I project, if I'm dollar cost averaging, what my potential annual dividend income could be based off of my portfolio, okay? Based off of how much I have. Now, if I were to go and say, okay, I'm gonna have, instead of 1.7 million, let's say 1, 2, 3, I have 1 million. And you can see how this impacts the dividend and the dividend CAGR, as well as the annual dividend income. And you can see here how the numbers automatically updated. So everything here, and you can see it here, how it updated. You can see here how it updated. So it really, all you have to do is update what the fields that are in orange to get, to personalize it for you. But let's say, for example, you're a rock star and you got 2 million, right? You can see how that would impact your overall yield, your overall CAGR, and your overall dividend income that you would be getting. Now, let's say, for example, I did 50-50. 1, 2, 3, and then we did 1, 2, 3, 1, 2, 3. You can see how the dividend yield changes. You can see how the CAGR changes, and you can see how the dividend income changes. Now, before we go and I show you the example of the subscriber that I spoke with this week, let me show you how this can look like if you're like, well, Jake, I need a higher dividend yield than 4. I need a 5 or 6% dividend yield. Now, I didn't pre-model this, so I'm kind of doing this on the fly here, but let me show you what that could potentially look like. Let's say, for example, you're retiring tomorrow and you're like, Jake, I'm not dollar cost averaging anymore. I need, the money today. I need a higher yield today. Well, then what you could do is you could say, okay, well, maybe if you did 15% in JEP-Q, 15% in JEP-E, maybe you did 5% into DGRO, what could that potentially look like? Well, you're getting a little bit of a higher dividend yield. And then you can see here, okay, well, we have, this totals 111%, so we need to reduce 11%. So then what we could do is we could go in here and we could lower, the one, some of these companies in here that have maybe a lower starting dividend yield, we can lower some of those. Let's see what that equals out to. Let me pull this up. We need to lower 3 more. Let's say we lower this one. Let's lower that one and let's lower that one, whatever, right? Just as an example, you can see that this came up to 4.75%. Okay, that's not bad. Well, we're at just under 100,000. Now let's say, for example, well, Jake, that's close enough. That's close, but I need a little bit more. Well, then what we could do is we could say, okay, well, we know BTI has a massive dividend yield. Why don't we bump BTI up to 5%, Ultra Group up to 5%, and we move this up to 20%, bring this down to 10 as an example. Let's see what we have there. We need 4 more percent. Let's just say this is 14, whatever. Okay, so now you can see, okay, the dividend yield is 5.15. The dividend CAGR is 9%, give or take, right? And then you can see here that the dividend income over here on the left, that the dividend income is over $100,000. So really what it comes down to is it's numbers and math. And these are the different levers that you can pull depending on your time horizon, depending on your goals, depending on your risk tolerance, depending on what you're looking to do, the destination that you're looking to, get to. You can then pull the different levers in terms of how you have your portfolio set up so that you can reach your goal. Okay, so for some people, this may be the right approach to have more into cover call ETFs. Some people may be like, that's not really what I want to do. I want to focus more maybe on, something else, right? Whatever that may be, whatever you're comfortable with, but this is how you find the balance to increase your dividend yield. And now here, before I forget, we can go down here and we can see how that impacted the REITs as well, right? It brought the REITs to 5% each, which is, in my opinion, a little bit high. I personally wouldn't like to do this. This would be a little bit, I wouldn't want to have 5% into, DLR and, I wouldn't want to have so much more in these REITs than, for example, 1% in Duke. I would rather have more in some of these other, qualified dividends than, for example, in some of these REITs. It's just an example. But the gist of it here is when you're thinking about your portfolio, you want to think about it, one, holistically, and two, you want to pull the levers so that you get the ideal dividend yield and dividend CAGR that's going to help you get to your destination. So now I want to use the example of the subscriber that I spoke with here earlier this week. So what I recommended that he do was list out all of his accounts, all of the different individual holdings in each individual account, similar to what you're seeing here on your screen, so that he has a holistic view, an entire view over all of the different companies, ETFs that he owns in his portfolio, so that he can know and understand approximately how much he's going to have invested into each individual company. So now I want to share the example of the subscriber that I spoke with here this week. And I want to kind of walk you through what I walked him through and kind of share some ideas and things to consider when you're thinking about this. So with M1 Finance, they make it so easy to build your pies, build individual, slices and a slice within a slice, all of that stuff. And, it can sometimes make it difficult to visualize and understand how much you're going to be actually invested into each one of these individual companies. So I want to give a few examples of what I shared with him, and I want you to kind of follow along, and maybe this is helpful, and maybe it will help you when you think about how many different companies you have in your portfolio. Because ultimately, that's really what it comes down to, is if you have too many companies in your portfolio, this might be a little bit shocking to you. Okay, so first off, the subscriber here, he was looking to invest about $500,000 as his target, as his goal into this portfolio. I think was it 250? I can't remember if it was 250 or 500,000. For this example, I'm going to go with 500,000 just as an example. So $500,000. If he's investing $500,000 into this portfolio, how much is he going to be investing into each individual company? So let's go in here, for example, and let's look at this slice right here. So you got retail, consumer staples, et cetera, et cetera, et cetera. So I want to take a look at one of his consumer staples. So his consumer staples, he has some great companies in here. He's got Honeywell, Colgate, the works, some great companies. So what I want to do is I want to say, okay, he's got, let's just take Honeywell as an example. No particular, we'll just use Honeywell. So Honeywell represents 0.1, so 10% of this slice, okay? Now, how much is allocated to the consumer staples? It's 20%. So what we're going to do is we're going to take that 0.1 and we're going to times it by 0.2, okay? So that means he has 2% allocated to this slice into Honeywell. But that's not it. He also has only 25% allocated to the individual stocks, okay, in this overall slice. So what we're going to do is we're going to time this again by 0.25. That means that he has invested just allocated 0.5% into Honeywell, okay? So 0.5%. Now, if he has $500,000, what amount is he going to be actually invested into Honeywell after 20 years? So let's assume that he's dollar cost averaging for the next 20 years. And let's assume, which is unlikely, let's assume that he keeps this allocation for the next 20 years. How much is he going to have invested into Honeywell? Well, you times this by 500,000. In 20 years, he's only going to have 2,500 invested into Honeywell. And then I asked him, is that a lot of money? And he looked at me, he's like, not really. That's not a lot of money. Now, especially if we're talking about a 20-year time horizon, okay? In 20 years, 2,500 is not going to be a lot of money. Okay, let's just keep it real here. So what does that mean in terms of the dividend income? Well, right now, Honeywell is trading, or has a current yield of around 2%. So let's say, for example, that Honeywell at the time is yielding a forward yield of 2% at that point in time. That means that on an annual basis in 20 years, he's going to be getting $50 in annual dividend income. $50. That won't even buy you a burrito at Chipotle in 20 years. Oh my gosh. Oh man, I'm on fire today. Okay, so reel it in here. Reel it in, Jake. Reel it in. Okay, I know I'm hilarious. All right, so $50. You can't even get freaking guac on the side with that, right? The rate of inflation. Anyways, $50. You divide that by 4 on a quarterly basis, he's getting $12.50 every single quarter in 20 years. You can't even get a side of chips for that in 20 years. Okay? So I asked him, I said, do you really feel like an investor, a shareholder of Honeywell, if you're only getting $12.50 every quarter in 20 years? He said, no, probably not. And I think, everyone has to answer that for themselves, but that is the reality. When you invest into 48 different companies, how much you're really actually how much you're really investing, and how much dividend income you're actually legitimately getting from that investment. So what I suggested they do is consider, well, why not consider the core and the satellite approach, where you have your core, which is made up of your passive indexes, your ETFs like the SHDs, DGROs of the world, and then picking a handful of individual companies, if he so chooses, and then limiting the amount that he had, but also limiting them so that they're not over 5%, right, of the overall portfolio, and then running that again, right? And so it's important that you understand, if you have too many companies in your portfolio, what kind of an impact that is going to have on your, projected future dividend income per company, right? And then you have to ask yourself, are you going to be able to pick the winner better than the index? And I asked him that as well. But when you pick individual stocks, you are saying that you know better than the market and that you're smarter than the market. So when you understand that, it really makes the case that, well, investing into indexes or, ETFs, like, the SHDs, the DGROs, it makes a lot more sense, right? And then if you do want to dabble into individual stocks, you can do that, but just have a game plan, and don't just blindly go and set up your portfolio, build out your different slices with 10, 20 different companies that you may not have any clue what they are, and then to realize that you're only going to get a couple of dollars a quarter in 20 years is something to definitely think about. And that's where the portfolio modeling comes into place, and it helps you understand what you're invested in, where your money is going, and how your money is working for you. Because at the end of the day, what really ultimately matters, the investments, they're just vehicles. They're vehicles to get you to your destination. And your destination, you define the destination. You set the destination. And that is unique to every single individual, okay? But the destination, you have to make sure that you have the right vehicle that's going to get you there. Thank you so much for watching, everybody. I hope that this video was helpful. I hope that you learned something new. I hope that this gave you a new way of thinking about your portfolio. And as always, I'll catch everybody in next week's video.
So please whatever. I want to reach 1 million likes. Okay, thank you.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.